Housing sentiment is at a decades low right now. People aren't wanting to buy houses. And not only that, interest rates are going up. So this is a crazy time in the housing market. So we got to figure out what's going on. That's exactly what we do at the Gray Report. I appreciate you taking the time, spending it with us. On the Gray Report, every single week, we're breaking down all the latest research reports, data, articles, everything related to the multifamily industry, commercial real estate, and then those macroeconomic events and factors that are so important today. So if you're a multifamily investor, whether you're active or passive, this is the YouTube and podcast show for you. Make sure you subscribe so you can get every single one of these videos. Like the video. Matt Bosnagel, Director of Communications and Marketing from Gray Capital, is here with us to kind of break all of this down. Let's get into it. All right, everybody, welcome back to the Gray Report. Matt, again, another great week of a lot of interesting information tracking the multifamily market, real estate, everything that's going on right now. It's pretty insane. First off, how's your week going so far? We're in the summer.
Pretty productive, actually.
Productive?
Yeah, for a summer. Yeah, I'm not being lazy. I'm not laying out.
No, not yet.
Not yet. A little bit.
It's a nice day today, so you'd be amiss not to at least consider it.
Yeah.
But
you've been gone for this week. You've been at a family office conference. I was kind of wondering how that went and what they're talking about.
Yeah, so every couple times a year, I attend a few meetings that's really kind of centered on family offices. So there's family offices from around the world that attend, as well as a lot of just like wealth management firms.
Any institutions?
RIAs. Some relatively decent sized institutions.
Okay.
Some pension funds, some insurance companies, but mostly family offices and RIAs, registered investment advisors. And so, I love going to conferences where everyone else is doing really big things.
Yeah.
And, the really smart people, they're managing a lot of money, smarter than me. They're seeing more deals. It's just getting so much information. And again, it's like kind of where is the smart money thinking about making plays? So it was really fascinating. And honestly, a lot of what we are covering on the reports today is also on the top of mind of family offices. No surprise, though. I mean, there's a huge interest in real assets, real estate, and commodities, with multifamily being probably the most popular, real estate asset class of interest. And if everyone is relatively, still bullish on the sector, but there's just so much uncertainty. Yeah. So obviously, the topics weren't too different from what you may kind of hear on kind of the mainstream, talking about inflation, talking about interest rates, potential recession. Most people aren't thinking that there's going to be a recession, immediately. It's possible, but most people are, kind of downplaying that fact. Yeah. But really, real estate and commodities, and what you do in this kind of new environment that we're in.
That's what I was wondering. And we talked about this like about a month or two ago, even when we're talking about an impending recession, and we're talking about people that may be more nervous about investing in multifamily, but what's the alternative? Yeah. Commodities. At least if they've got these kind of ideas in mind, then that's one thing. But to me, it's like a recession is a situation in which the investment for across the board could be difficult.
And and the problem with commodities, like a lot of people were talking about, is they can be great in for a short duration when there are these run-ups, and there's talk of this commodity super cycle. But looking at commodities over a 10-year hold period, historically don't necessarily perform that great. Over a short period when things are running up, if you look at copper, look at a lot of other
lumber was
up, and now
it's down. I remember if it could only just get back to $600. Now it is. And I think it's below,
like 200 per whatever random length board to 1,200, and now it's so it's still up, but it's not insane.
Mm-hmm. But other commodities haven't gone down at all. Yeah, and it's crazy just to think where that labor is and where that takes a real PhD.
Yeah, and so so for on the long term, they're okay. Well, maybe commodities aren't the best. Maybe short term right now, but again, it's like real estate that trades out leases at a relative high frequency. Okay. So not necessarily net leases, but multifamily and hospitality. Still a little bit of softness on the hospitality front, although some people are kind of getting into it. But a lot of interest in multifamily. Less interest in tech, a little bit less interest in venture capital. there is much interest in kind of multifamily real estate as there ever has been.
So was this conference that you went to? There were all kinds of investment assets.
Yeah, all kinds of stuff. There was a lot of real estate,
Yeah.
but kind of pick your asset class, everything from blockchain and crypto to cannabis to
And the
VC.
atmosphere was still people murmuring about real estate, not necessarily talking about blockchain.
Yeah, much less talk about blockchain
Okay.
than at previous meetings. The last meeting I was at, it was a ton of blockchain discussion.
Yeah.
People are still interested in it, but have definitely softened to it. And I think are deciding, hey, let's kind of get back to the basics here and what we know is going to work, and less kind of appetite for risk. And we want something that's stable. We know it's going to work kind of over the long run. And the fundamentals, I mean, the thing that just kept getting echoed is like the fundamentals for multifamily are really strong.
Well,
just what's real, it's just interest rates.
And one thing that I didn't talk about, that I didn't put on this video, but I did put it in the newsletter, was negative leverage.
Yep.
And, negative leverage is increasing in CRE space. But as you said last week, this investment into like crypto, that kind of stuff, it's in that same genre as negative leverage, in that you don't have a fundamentals that are kind of driving the income, and you're just waiting for the end of your investment cycle.
Yeah, waiting for someone else to pay more for it.
Yeah.
At the end of the day.
Yeah.
And there was 2021. People had so much extra money. They're like, I've got to put it somewhere. And so sure, I'll take a risk on some more growth. Real risk assets like crypto or speculative tech. And there's just so much less appetite for that. And we're seeing that kind of those markets correct, and all those asset classes that are, I would say, more like discretionary. Like you wouldn't normally invest in this, but if you only would if you just had extra money you had to put somewhere.
Yeah.
And so, we're seeing it, in, random, sectors as well. Like something that I read recently is like the luxury, like watch market, like, it was going crazy, like other things. And like, whatever you want to pay for a Rolex, the prices were totally insane.
Yeah.
But like, been a total correction in like the luxury watch market because people don't have an extra like $10,000 or $20,000 like they were on paper. There was a wealth effect. Everyone saw their stock market portfolio is way up. Now it's not.
Well, and even in the multifamily arena, like let's say you do get negative leverage. If you have that patience and you have that faith and you really think that you're going to get the growth at the end, then maybe it's worth it.
Yeah.
But I think if you're kind of assessing the general sentiment of everyone, I don't think it doesn't seem to be that smart to be jumping in.
There's still the idea, because rent growth is so high, which we're going to get into. There's still kind of the sentiment that like cap rates don't matter. You're kind of going in cap rate means much less to what your returns are. Will be based on your business plan, assuming that your business plan is somewhat conservative and kind of in line with reality. And you're not speculating too much because we are, as we're going to see, really strong rent growth, or we're already seeing it. So let's just get right into that, Matt. Apartment list. Apartment list vacancy index, a new report. We feature apartment lists quite frequently. Matt, before we kind of get into all the details, you want to talk about the methodology on apartment lists? Because I know that's something you want to touch on.
The methodology section, I appreciate kind of how forthright it is about its role. Now, apartment list, it has a service that multifamily professionals can pay for that's aimed at reducing vacancy. They're selling something. A lot of the reports that we have, someone is selling something, but a lot of times that they're not as direct, kind of as they are here.
Yeah, true.
Some reports don't even have a methodology section, but they do cite their sources with some fine print at the bottom of the page. Some sources don't have a methodology section at all and don't really cite their sources for their numbers. When I read these reports, when I read these reports, I think I'll trust these numbers. But thank goodness for them. I'm such a trusting person.
Well, thank goodness for you, Matt. Not only going through these reports, but really kind of tracking the differences.
Well, and that's what
methodology
I was gonna,
and
and that's what I was going to say. Like, with any report, especially reports that have numbers that other people have. When we're talking about vacancy, there's other reports that have vacancies, but they're going to be a little bit different. And reading this report or any report along with your own experience, what's your boots on the ground experience, laying that against other reports that measure apartment demand, that's what makes it worthwhile.
So their methodology for this is from their own data, is what you're saying.
Exactly. So it's their own data, and I like that they say, they have a little paragraph that basically talks about, because apartment list is so effective at bringing down the vacancy, they actually have to adjust their vacancy numbers.
Oh, we do such a good. Okay, so
Exactly.
I see
That's
what you're
like,
saying. Like,
yeah.
so
if
our
you scroll
data,
down, there's a graph there.
Our data has artificially low vacancy because our product works so well at decreasing vacancy.
And when they're so direct about that and so upfront, it's like, okay, I will take that with a grain of salt. But dang, it's a more valuable grain of salt.
At least they're doing that.
I think honestly that laying out their process and their role here ups their credibility for me. And so again, you shouldn't read one report in a vacuum and take that as gospel. But if you have a fuller understanding of where they're coming from and where their data is coming from, then that's going to help you place that on the right chart.
Yeah, I agree. So one thing, and maybe they touch on this, Matt, that you can comment on, but here's my only issue maybe with that. I think that's good. They're kind of discounting, but they're also, I assume, measuring over the period that we've just seen natural vacancy declines.
Yeah, that's very good point.
So, it's like, correlation, causation, like, yeah, your vacancy is dropped, but like everyone else's vacancy is dropped. They're saying their vacancy's dropped even more than the average. Is that what they're saying? Or
that is
are they
possible.
Really parsing
I think that actually just at an absolute level, their vacancy drops from around, a little under 15% to a little above 5%. But they do have numbers from 2017. They're just starting now to record apartment demand.
Okay, got it. So, okay, let's look at
with that preamble out of the way.
No, I think that's important, just in good context for all these reports.
And so if you look, we're looking at this chart here, and it shows how at the start of their chart in 2017, vacancies were bouncing around the mid to upper 6% range, and then after the pandemic started, vacancies peaked in July 2020 at 7.25%, and then after that, vacancies went all the way down, bottoming out at 4.07% in October of last year. Since last October, vacancies have increased to 4.9% or 4.95%, but the rate of this increase is flattening out. I think that looking at the pre-pandemic trends and how they were kind of bouncing around, it looks like there is this regular seasonal bounce around April and May where vacancies are high, and then around November, December, vacancies fall. I wonder if the new average, instead of bouncing around the upper 6% range, will now be kind of bouncing around the lower 5% range.
Yeah. Yeah.
So a full percentage and a half almost of differences between pre and post pandemic.
So, and that makes sense because, there's a lot more turnover in the summer because of peak leasing season.
Yeah.
And so you have to have units are down for turnover, and then, but everything's leased up kind of by the time everyone gets to school,
Yeah. And I remember in discussions with our asset manager talking about, what is the ideal vacancy rate? What's the ideal occupancy for a specific property? And sometimes if you want to move rents at all, you have to accept that may increase vacancy, but you will kind of seize that opportunity a little bit more easily if you're comfortable with losing some to vacancy.
Yeah. Well, this is a difference between kind of like newer school and old school management practices, where like old school, it's like, hey, we want it filled up, 100% occupancy. Mm-hmm. And let's just, not move rents. We'd rather have the thing, leased up and full and not worried about it. But you can actually make a lot more money having rents be higher and at 95%.
Well, and it's kind of, it rhymes with the employment situation. You don't want zero unemployment because then there's no movement. There's no mobility. Yeah. You want to have that vacancy to allow people to kind of move in and out. Well,
you don't hear the politicians saying that much, that like we want
right.
unemployment to go up, but that's what the stock market is secretly shooting for. And the Federal Reserve, and certainly the White House would never say that because wow, that would not be a good soundbite. And just quick, because we like to check in on Indianapolis, it's our home market. Because they break this down by every market. Indy's doing even a little bit better compared to nationally, looks like, because we saw even a bigger drop. Now we were slightly had higher vacancy compared to the national average prior, but then we dipped way below that, and there is a little tick up here, but it's not nearly as much.
Yeah, that's a really
average.
Good point.
Yeah.
It dipped lower and it didn't go up as much after that October low.
It's really flattened. And part of that is just, again, because we haven't had the supply coming online. I mean, in Indianapolis, we're seeing a ton of job growth and population growth. So I think that'll make sense. So, Matt, what else would you like to cover on this report? The expensive coastal cities, or is that
that's really it's a quick review, and this is a report that's going to come out now every month from Apartment List. That's so great. We'll be kind of looking forward to it.
We'll track it every month.
Be able to track it, yeah.
And again, to check out the stuff on a weekly basis. If you sign up to the newsletter, this is packed full, way more reports than we feature on the show. You go to graycapitalllc.com/newsletter, get signed up, or just go to grayreport.com. This stuff is updated every single day, all these reports.
I updated it so much the other day that I crashed the site.
Oh, yeah. Okay, that's what that email was about. Okay, that makes sense. I was like, I don't remember sending in a ticket. Okay, Yardi Matrix, National Multifamily Report. Yardi Matrix is, they're also a property management software company, but they got a lot of data because of that. They put these reports out every single month. Multifamily posts broad gains in May. Matt, what are some of your takeaways?
I love to read things like multifamily rents continue to defy gravity, and that seems to be the theme. At least this is what I talked to you about when I was trying to kind of characterize the reports that came across today. Is like, I am almost a little bit surprised by how great multifamily is doing. It's not the kind of disbelief, the kind of hyperventilating heat of the market of 2021, but it has had such stable growth and all these signs that people were talking about last month, or really even right now. They're talking about this inevitable cooling, and I think actually that may even be, yes, that is also in the Yardi Matrix report. There's a quote that says, "Signs of the inevitable cooling may come from the weakening occupancy rates in some high growth metros." That's, again, something that we have talked about before. The places like Phoenix, Boise, Miami, Orlando, Austin, Tampa, these sunny places in that belt across the southern United States, they might be more vulnerable to changes in apartment demand. It's the ones at the top that, especially, considering that people are a little more mobile maybe now, and now that's arguable. We'll get to that. But that's kind of where I think things might be going in the future. Now, when we're talking about rent growth on average, it was at 13.9% year over year. That's a slight deceleration, but it is due more to 2021 base effects than anything else. Now, let me get into this, because
we really wouldn't want to see like much more than 2021, because that was the point where it's really becoming unsustainable.
And that's, investors probably know it snowballs every year. If you're growing 10% every year, it's 10, and then it's 11, and then it's 12.2. I don't know, but it gets bigger and bigger if as you go along. Now, this is what I mean when I'm talking about base effects. The month over month rent growth actually was higher for May than it was for April, but the year over year rate went down. So that's because we're getting into the heart of the rent increases when we're comparing now from last year. Those increases from last year were so big that we can have increasing month over month numbers and still have lower year over year numbers. So when you're comparing yourself to the boiling hot 2021 rent growth, it might not look bad, but it's not bad at all. This is a case where, looking at a bigger picture can kind of blind you to some worthwhile insights about where the market is moving today.
That's fascinating. This is a great report. Again, you can find out if you have or sign up for the newsletter. You go to grayreport.com, because it covers different residential asset classes, short-term rental, single-family rentals, as well as employment and supply trends, forecast rent growth. Oh,
I do want to say, when we're talking about forecasts, this is what's one of the most interesting things, and really what raised my eyebrows. How high is rent growth? Well, at the beginning of the year, Yardi Matrix predicted 4.8% rent growth for the full year.
For the year?
For the year. Now, for today, we are at 4.7 rent growth. And that's for May.
We called that. I remember we were talking to Noah Stone. We were like, what are you, okay, you're just reverting to the mean. What else are you basing your forecast on, other than just like statistics and just not... I don't like using the term lazy, but I'd rather them say we don't know. And some people just, we don't know, but they don't want to forecast another 10%, which is it's looking like it might be in the 8 to 10%. I mean, right now
that's what it's feeling like. Now, I don't know how rent growth is going to go for the second 6 months of the year, but the first 6 months, if they're anything like the first 6 months, then we may be seeing
We've
close
got
to
another
10%.
month or two of, in peak leasing
Yeah,
season.
so that's 4.7 in 5 months. So then unless things seriously cool down, unless we're experiencing the
no
heat
rent
death
growth,
of the
it
universe,
just stops.
then maybe they might be accurate, but I don't know. I think inevitably, things are probably going to cool down, but we will have overshot many people's estimates, and that's what I'm seeing right now, and that's what makes me so optimistic about the future of the multifamily market for 2022 at least.
And just quickly, I want to kind of go through, because again, take some more time on your own, but we're going to looking at forecast rent growth, and then for year-over-year job growth. I think in a lot of different markets is pretty interesting. Again, Indianapolis job growth pretty good. We went 4.2%. Kind of right there in the middle of the pack, really looking very similar to quite a few Sunbelt markets. But what I like to look at is, what the growth is, what the employment growth is compared to the completions as percentage of total stock. Because you can have a ton of job growth, but if you're building way too many units, you still could be oversupplied. I'd rather see moderate job growth with less supply coming online. And that's where, some of these markets that have pretty minimal new inventory. Orange County hardly has anything. Las Vegas, that's a pretty interesting, relatively low number. Kind of surprisingly that is that low. Portland at 2.2. But look, Indianapolis 1.3%. Inland Empire 1.1%. That's a fascinatingly low number based on job growth and rent growth. Now, building in California, there's a lot of reasons why people don't do it. So a lot of these California markets are relatively low. Sacramento. And again, these are the markets that need it, which is fascinating. But outside of California, I guess you have Baltimore that's pretty low as well. But Indianapolis looks pretty interesting from that perspective, Matt. All right, well, so Matt, it's not a great time to buy a home. That is not a surprise. That's a comment that you made, or really a takeaway from Fannie Mae's National Housing Survey.
That's what the respondents said.
That's not really a surprise that people are saying that, with housing prices being so high and interest rates, your monthly payments up 30-40% if you buy now and borrow now compared to last year. But what else is, I guess, Fannie Mae, what other insights really popped out?
So only 17% of these survey respondents think that the timing is right now for buying a home. Looking at their numbers, it hasn't really been a good time to buy a home since March of 2021, when 53% said it was a good time to buy a home and 40% said it was a bad time to buy a home. I guess 7% were on the fence. But looking at a longer view of Fannie Mae's Home Purchaser Sentiment Index actually makes it even more dramatic.
Yeah.
We're kind of entering not exactly uncharted territory, but certainly unusual territory.
I'd say uncharted. Pretty good.
Right,
Pretty good term.
Home buyer sentiment is at 68.2% right now. And the last time it was this low was 10 years ago during the long crawl out of the great financial crisis. It was briefly down to 67.5.
So it's 2012?
Yeah, 2012.
Last time would have been a pretty good time to buy.
Exactly. And so it's a very interesting, we're talking about sentiment. This is what I said. It's like these are people, and when you're buying a house, you're buying with your heart and not really necessarily with your head.
But you'd think that but people are at least trying to use their head, because the only difference between now and mid 2021 when it was kind of inverted is interest rates and the cost.
And that's what I think really is the real prime influence here is interest rates. This is defined by interest rates. I think that the other factor maybe is obviously is the pandemic. So I'm pulling out an outlier. The home sentiment was 67.5 at the start of the pandemic, but I'm going to kind of throw that out there. Really, it's all about the interest rates, and you can see this graph where there's a clear downward trend in home sentiment. Now it's interest rates, but I think that the extended trend is because of home prices increasing so much. An interesting breakdown, and now if we're talking about these factors in the next year, now these are all factors that will kind of influence home sentiment, home purchasing sentiment. In the next year, more people think their income will be significantly higher than lower by 26% to 16%. More people think that mortgage rates will increase rather than decrease from 70% to 4%. More people think that home prices will go up rather than down from 47 to 23%. And then more people expect to keep their job rather than to lose it, 81 to 16%. Really, kind of, if you're extrapolating kind of some kind of like economic or job confidence figures, it seems like people are pretty happy with their jobs and they expect that they're going to be paid pretty well in the future. If you're if you're kind of extrapolating, well, will tomorrow be a good time to buy a home? It looks like no. So this is a statement of current housing sentiment or current home buying sentiment, but it sure does seem like future sentiment is not going to be that great anyways.
What's interesting is that like they're basically saying that the shift and there's like cross happened between good time and bad time was April of 21, but isn't that like this time period around the time period that in March of 2021, it was had basically been at its peak? Or is that what this is saying, Matt? Or am I missing?
So that was when data? It was. I'm sorry. Let me track here. It was a good time to buy a home. It hasn't been a good time to buy a home since March of 2021. That's when it crossed, and then at that moment, got it. 53 said it was good and 40% said it's bad. Currently, now we're at 68.2%. And if you can kind of hover over that graph on the tail end, we'll see how many people think it's a bad time to buy, and it's about 79%.
Yeah, 79% of people say it's a bad time. But also it's interesting about this is that like people have, it looks like since they've been doing the survey since 2012, have been thinking that it is the people have less and less people over time have thought it was a good time to buy.
Yeah, that's the general trend. That's a really good point.
And then it just like completely fell off. Even when people were buying and they thought it was, it was good. It's a good time to buy. Less good. I mean, in 2012 it was 70%, and now it's what 19%, 17%.
Yeah. So the pandemic, or the industry environment or whatever, has really accelerated trends that were there, but just kind of more mild and less dramatic.
Yeah, that's fascinating.
So that was kind of an interesting breakdown of the factors and historical context. But with people so bummed out about buying homes, with this pessimism unseen for nearly a decade outside that outlier, it sure seems like home prices could go down. The lack of new housing supply and the lack of interest in putting homes up for sale are on one side. That's kind of creating more scarcity, keeping home prices up. But on the other side of this are these multiple factors that are dissuading people from buying a new home. And I think, like I said before, the real factor is the increase in mortgage rates that kind of snapped people awake. The fact that this increase in mortgage rates has made such a huge difference in home buying confidence could imply that prices were elevated beforehand. And now they're just kind of, they're kind of waking up. Maybe. Yeah. What will be interesting, and I'm not sure if there's a base effect. Base effect. I don't know. But going from a 5% Fed funds rate to 1% Fed funds rate, that's a 100% increase. Yeah. Going from 1 to 1.5 is a 50% increase. My point is, like, is there a case to be made?
150 from
50. But like my question is there a case to be made that each subsequent interest rate increase will have a smaller effect on demand, or is there just going to be a snowball effect? So if we're from zero,
is it linear, or is it what's the curve?
Yeah. Is this gonna have diminishing returns?
When does the demand destruction really start to occur? And it appears to have started on the margins, but not full on wholesale, where we're actually seeing prices decline, because we're not seeing prices decline yet. And I also wonder what kind of the Blackstones and these large groups, private equity groups that are buying up single family homes, typically in the kind of the starter home range, because they're trying to turn them into rentals. If that, what kind of backstop that provides.
Oh yeah.
And so there's been a lot of talk of, you're really never there's gonna be renters for life, or at least for the foreseeable future, because there aren't going to be any homes to buy in that kind of $1 to $400,000 range, because they're all going to be purchased. You can rent there. But then again, it begs the question of what are people really looking for when they think we think about the American dream and like you having your own place. Does it mean that you really own it? Do you ever really own it? Government, you pay property taxes. Is it about that freedom? Is it about getting that 30-year fixed mortgage? Is that truly the American dream, or is it really to have your own place and having space, and you kind of find that financial freedom by taking control of your finances, and that may not be the same thing as buying a home. You could go invest in an apartment syndication. You could, invest in the stock market.
A payment is a payment.
Yeah.
Whether it's to rent or to a loan. Although, I don't know, as a child, I always dreamed about paying off the right kind of loan. That was my dream.
Yeah. There's sometimes debt you want to pay off. Sometimes it's fine to
that's true.
Find to hold on to if you know what you're doing.
Yeah.
Because debt it's kind of like nuclear weapons or weapons in general. It's like used correctly, you can get I don't know what. I'm like, nuclear weapons are okay. Maybe when we launch them, deflecting a meteor, or the whole idea, launching one into a hurricane. I think that Trump thought about doing.
If we ever wanted to restart the sun,
idea.
if the sun went out, we'll probably
think that would work.
Yeah. Yes.
Yeah. Perfect.
We're the experts.
Yeah. On science.
That's right.
Exactly. Okay, Matt. RealPage, U.S. apartment market showing no sign of slowing down yet. That's basically what you were saying. That's what a lot of these reports keep alluding to, and I think it's because we keep waiting for it, because a lot of these reports, like a couple months ago, were like, we're going to see a slowdown, and then they're like, well, it's checking in on it, we don't see it yet, and I think a lot of this is obviously correlated to inflation. We're not seeing like we're seeing some slowdown, but we're not seeing like a major slowdown. Rents outpace inflation, that makes sense, and then you put in the lack of supply. That's a whole other factor that's accelerating this difference. So what does Jay Parsons from RealPage have to say about this red hot rental market?
Yeah, so they talk about trade out leases, new leases, but they also have information about renewals. Rent growth for renewals is increasing pretty robustly as well. But when we are talking about new move-in leases, renters are paying 19.5% more for them, as opposed to the people that were kind of living there before. For renewals, Class A and B renters are paying 12% more than their old leases on average, and Class C renters are only paying about 7.9% more, which is below the 8.3% inflation rate. And renter incomes have also increased by 8% for market rate apartments. And as for demand, this is a quote, prospective leasing traffic, an early indicator of demand, appears to be leveling off from the all-time highs set last year. Of course, leveling isn't the same as cooling. To that point, leasing traffic in May 2022 was still higher than any other May on record prior to 2021. So leveling off is not the same as cooling off. Yeah. I agree with that.
Yeah, no, absolutely. I was surprised to see some of these renewals are pretty high. I mean, kind of in the 12% range.
Yeah.
And I think that makes sense on we're in the C-class assets. We're not seeing as much growth because a lot of those residents, they're pretty strapped right now with inflation. They're getting hit absolutely the hardest. Paying for gas, everything's more expensive. They have less money to pay up for rent increases. It's the most sensitive group. But what I think is going to be interesting is if, like, let's say we do see a recession and we see people who were living your B-class apartments. They need a cheaper place to live. They're going to start going into the C-class apartments. That's where they were paying $1,000 a month. They're looking for something that's paying $900, but the apartment was being leased for $800. So
that could slowly creep in. Man, that's a good point.
Yeah. So, but I think that's typically we'll see if that catches up and there's some slack in the C-class. Could not be. And then that's why I talk to investors all the time about the importance of being diversified. Not just general diversification, but kind of inside. Like, I want to invest in multifamily. It's good to be diversified across kind of the income spectrum. Because in different types of economies, you see different types of growth in different sectors. So whether it's like in some economic conditions, C-class properties perform incredibly well, and then B and A class perform well in other types of economies. Right now, we're seeing A class really outperform the rest. Typically, that's B class. I mean, B class is doing great, but A class is doing well right now because buying a home is so expensive. All those millennials who were expected to buy a home right now can't afford it, so they want a nice place to live and a bigger unit too.
That could impact your strategy for an individual property. 100%. Maybe you bought it, you want to take it up to a luxury apartment, or do you still want to keep this kind of more workforce housing? You can kind of stretch it, maybe put a plus
Yeah.
where there used to be a minus.
Yeah, so I think that's a really good point, and it's a good question to ask. And it's one we ask ourselves every day when we're in the middle of these multifamily projects and we're going through kind of a CapEx plan, what do we do for the renovation? Because on one hand, you have so much organic rent growth going on right now. So you could do nothing and you're going to get good positive growth. If you spend money to renovate the unit, which it may require a renovation, but let's say it's not absolutely necessary, are you getting the same return? Because you're going to have to spend a lot of money with increased labor and increased materials. Yeah, you'll get higher rents, but is the ROI on that renovation really going to justify it? And you also kind of have to bring that all the way down the road to what your eventual net operating income, kind of gross potential rent will be once that's all completed and when you sell it. But just looking purely at the return on investment for that renovation of we're going to spend $10,000 per unit renovating this apartment unit, and we're hoping to get a $200 rent premium versus spending nothing and maybe still getting $100.
Yeah.
Well, or $1,000, and so you spend $2,500 and you get $100, or you can spend $10,000 and you can get $200 or $250.
Yeah,
it's that ROI is pretty easy to that math. You don't need to calculate.
Very good point. Yeah.
Yeah. All right. So another report, May 22, Commercial Market Insights from the National Association of Realtors. Pretty interesting report, Matt. I know we've got some information on industrial growth as well as some other sectors. What really kind of popped out to you when you were researching this report and really kind of digging into it?
Well, first, it looks like industrial growth is doing a little bit better than multifamily.
Yep.
But I don't think that they're doubtful about multifamily growth. If anything, the tone they set is pretty confident about the apartment market. NAR mentions growing occupancy numbers for multifamily and shrinking occupancy for industrial. So there's still some open competition between these two property types when it comes to their performance. When it comes to sales volumes, multifamily is a clear leader with $265.2 billion, which is more than double the number for second place, which is industrial at $119.6 billion. There's less investment in the second quarter of this year as a whole. And really, there's some disappointing numbers for REITs. I thought that those figures were and that's kind of down on the report a little bit, but those figures were some of the most interesting. That's that bar graph there. On the lower, it's a little lower down though. Okay. Now, so aside from hotel REITs, which were up 9.1%, and timber REITs, which were up 3.5%, all other REITs are down for the year. Now, just to explain what REITs are, now you can correct me if I'm wrong here, because I'm going to dramatically oversimplify. REITs are like stocks you buy for real estate. And there's a technical definition, but that's how I classify it in my mind.
Yeah, I mean, real estate investment trust, they have to you can have public traded REITs that you can buy in the stock market, and then there's some non-traded private REITs, but it's a filing in the tax code that they have to distribute 90% of their income back to shareholders in dividends. And the advantage to the REIT is that the corporation isn't taxed, but the investor has to pay the tax. So the disadvantage, and actually at this family office conference, and I was really glad this was on the report because there was a great presentation on REITs compared to private market real estate. So in a bear market in bonds, interest rates are rising, which means the prices of the bonds are decreasing. Publicly traded REITs do absolutely horribly. He was basically saying, do not why no one should be, and people were really, as a matter of fact, no one should be investing in public REITs. Because they track so well with you have all of the public market volatility, people trading on a daily basis, because the people are essentially using them as fixed income proxies. I'm trying to, or just for some diversification, but typically trying to get a little bit of yield in that dividend, which the dividends are just okay. But private real estate is much more tied to actual fundamentals and the performance of the properties and the real estate market. When you're buying a REIT, you're really investing in a company that invests in real estate. You're not really investing in real estate. You're investing in kind of paper real estate that's somewhat.
But even that, it's to me, it's not the. The correlation is interesting, but for me, it's this idea of the public market aspect and how it's like. All right, this is the quote from the report. It says, and you can see how you can see the report writer kind of scratching their head
Yeah.
as they write it. And
they should have seen this presentation. We'll have to forward it to them.
It says, investors appear to be expecting more personal and business travel as COVID-19 cases have led to fewer deaths, even as infections have surged. Investors shied away even from REITs invested in assets that have strong fundamentals like apartments, single-family homes, infrastructure, and data centers. Rent growth for multifamily and industrial assets are outpacing inflation, making these assets a good hedge against inflation. So they're like, there's these good things. Investors are shying away from the good things, despite the good fundamentals, despite the fact that business travel hasn't taken off. Investors in REITs have driven the market in another direction. There's like this idea that, and this is kind of the situation that's one of the big drawbacks to me, at least for publicly traded REITs. You could have a 100% perfect view of the fundamentals of a given property type, but if more people are wrong, they could win. They could be the one that are making money. Even if events make those fundamentals make your guess even better than before.
Well, but they might not even be wrong though, but I think that they're looking at it through a different lens. They're not looking at it through a lens of how our apartment's going to do and what is the demand for apartment units. What they're looking at it is this is a fixed income product that is going to produce a certain amount of yield, and as that yield increases, prices decrease if it's related to the discount rate. And again, this was the argument that this presentation made, is that real estate, but much more specifically publicly traded REITs are essentially act historically as a levered long bond. Okay. And again, as if you believe that if we are in a bear market in bonds, which kind of like the average like period of like a bear market in bonds is like 16 years of rising interest rates. And so if you think we're going to see inflation rise, if we think we're going to see continued interest rate growth, you're going to see a decline in prices in bonds. And so if REITs are basically act like a levered long bond, and the levered long bonds are going to be decreasing in price because the interest rates are going up, then the REITs prices should also decrease because their yield is going to go up, because their cash flow is going to go up, which as inflation increases, so their price is going to go down because price and yield are inverted to each other. Whereas in private real estate, that is true in a sense that cap rates may rise as interest rate rise, because it's affected the discount rate and the risk-free rate, but they're much more tied to the actual like performance of the property itself and investor sentiment, and don't act as closely and don't have a direct correlation, not a causation, but a correlation to bonds themselves. Yeah, because they do outperform inflation.
So kind of my point about the public foolishness, I guess, was the balance within those REITs shows that maybe even the people aren't making the bets in the right places. But before I heard this presentation, I would agree with you 100%. They're just reading the headlines like things are scary.
So if you want to invest in real estate, invest in real estate where you're an owner of the real estate. You have the full advantages of owning real estate. If you want to invest in a fixed income product that is sort of tied to real estate, in a company that invests in real estate, sure, go with a REIT. I mean, the only real advantage of REITs is liquidity. Now, sure, they have to distribute their dividends, but if you're investing in cash flow in real estate, they're going to be distributing distributions and proceeds also. So unless you absolutely need liquidity, which no one needs 100% liquidity, but you're going to get a premium on illiquidity and a discount to liquidity, you need to be looking at actual real estate, private real estate, rather than these publicly traded REITs. And even non-traded REITs don't do that well. But it's because they are somewhat correlated to public markets. So if you want to invest in real estate, REITs are not the option, especially in this environment. Okay. And so that's just something for all investors to keep in mind. You're not going to do that well in REITs over the next couple of years.
All right. That's good to know.
Even if apartments crush it.
All right. Oh yeah, gosh.
So
it's a different market. That's interesting.
I was excited. It's hard to wrap your head around the idea that the fundamentals don't matter. Yeah, because a different fundamental of bond rates and that correlation is stronger than the actual underlying performance of the asset.
Yeah, yeah. That's harder for me to wrap around than the idea that people have gotten the wrong idea. And if more people have the wrong idea, then that can move the market more than, rightness.
But I mean, how many people, I think that there is definitely an element to that investor sentiment, and again, the liquidity creates that risk. I mean, we saw a lot of REITs, just completely fall out early on in the pandemic, and you would have gotten major losses if you were invested in REITs. But if you own private real estate, you wouldn't have seen any kind of losses, and actually you saw gains during that period. But so there is investor sentiment that can move too quickly, but how much of it is that, and how much of the market is made up of that?
Yeah.
Because I don't know if like people are like trading REITs like meme stocks or anything like that. I think it's a lot more institutional. It's a lot more serious investing, I guess. And so those type of investors, thinking smartly, selling the REITs, understanding the correlation between long bonds in general and REITs, and as yields go up, prices should decline as well.
Yeah.
I think it's certainly an element to that.
No, that's a good point. You have to look at the reasons why people are investing in their mindset. And without that, you could get lost.
Yeah.
Oh, it's good fundamentals. This will do well.
Exactly. Well, how many times have you've seen a product and the company's traded on the stock market and you're like, I love the product, I'm going to buy the stock. And then it's like, well, the company, it's a horribly run company. Yep. They don't have whatever the reason is. Just because they've got a good idea, it's like, well, if they're loaded up on whatever the issue may be.
Very good point.
The valuation could just be dumb. It's like, it's a great company, but it's like still worth 5 times more than it really should be.
Yeah.
So you always have that risk. And again, that's why there's nothing. Stock market has definitely its purpose. Diversified portfolio. Again, liquidity is very useful for a big chunk of your portfolio. But that's also one of the reasons. But on the other side, I love private real estate because you do get a premium on the illiquidity, and it's something we can control. I mean, personally, it's like, I'm going to go in here. I know that we can make money. I can force appreciation kind of regardless of economic conditions. I can hold on, and I know we're going to be successful. I know we're going to make money with a high degree of certainty because we're going to take all these actions, or we're going to control this process, or I'm going to invest with someone that is an expert in controlling that process.
Yeah.
Yeah. Well, anything, I guess, Matt, else that didn't make the report that people should check out on the newsletter or grayreport.com?
The only other thing that I wanted to mention, and I actually put it in the Sunday one, is I mentioned that before, this article on the upside down leverage, or what?
Oh, inverted.
Inverted leverage. Yeah.
Yep.
The upside down of the leverage world.
Negative leverage.
Negative leverage. That's what it is.
Yeah. So basically, your interest rate that you're paying is higher than the cap rate that you're buying.
Yeah, so that's just a development I think that is interesting. It's something that we speculated on, and to see that come in print, and to be kind of also other people are thinking about it is a really interesting development. And I wonder if this indicates if it's a sign that things are going to start to cool off, or if it's just a sign in certain markets it's just getting so crazy.
It has to be, because people have to ask themselves. And again, going in cap rate, it doesn't mean everything. And you could argue in this rate of growth, it means less and less and less. But you certainly need to be asking yourself some questions if you're using negative leverage.
Yeah.
Again, your cap rate is lower than your actual, or is lower than your interest rate. That's not good. Usually your cap rate should be higher than your interest rate.
I think there's all these talks about inevitable cooling, and there's these some nervousness, and not this. People are talking about a bubble. Everyone's always going to talk about a bubble.
Everything bubble every day.
But this doesn't seem like the environment of excessive exuberance that precedes a bubble. If anything, people are kind of hedging their bets.
2021 seemed pretty excessive to me in some cases. Yeah. But again, there's a lot of fundamentals that made sense. But when money was essentially free and you had near 0% interest rates, I mean that's what fuels it, and that's been cut off. Now it wasn't cut off too late. But I think that's the big question, and is just the lack of supply and then the continued investor demand going to buoy that. We shall be seen. I personally am excited for this opportunity because with rising interest rates, it's cleared out a lot of buyers out of the market. Taken out
some of that air that could have popped the bubble.
Yeah, it's true, because what's fortunately, and this is healthy, is lenders have gotten much tighter, and so you can no longer borrow at the higher leverage rates that you might have been able to borrow a couple months ago. So even getting 75% loan to value, which was relatively typical, you're not always getting that. If you want to do a deal, a lot of times it has to be kind of 60%, 65 or 70. Okay. And so there's a lot of groups, especially if they're not well capitalized, that's a lot more money you have to raise. And so you just can't, a lot of groups just can't raise that money and can't do that deal. And so there's a lot of syndicators, especially a lot of newer syndicators who don't have as much access to capital, can't raise as much capital, that are being completely taken out right now, or they have to do smaller deals. But it's the groups that can continue to execute with lower leverage, are still able to participate in the market. But because of that, there's going to be some declines in price growth, and cap rates have to move up. We've already reported that anecdotally cap rates have risen at least 25 basis points in most markets. A lot of prices off the top whisper, not necessarily what anything traded at, but what was being asked. It's down 5 to 10% kind of across the board nationwide. So we kind of have seen that self-cooling because of interest rates. And again, I think we're going to see a pretty incredible buying opportunity compared to last year. Yeah.
So a lot of reasons for kind of a stable growth. I'm not hyperventilating yet. No. I was hyperventilating a little bit last year, but I think there's plenty of reasons to be optimistic.
I agree, especially if you're in the right markets. There's certain markets that have different risk profiles than others, but I'm glad we're doing what we're doing, Matt.
Yep, for sure.
All right, guys. Make sure you're subscribed to the Great Capital YouTube channel. You're checking out the podcast, but leave a comment below, though, because we respond to the comments, and we'll feature the comments on the show if it's a good one. Ask us a question. Just give us your opinion. And then if you are interested in making some allocations to actual real estate, not paper real estate, but actual real estate, and you are an accredited investor, go just type in your browser gray.fund. You can learn about the Gray Fund. It's Gray Capital's multifamily investment fund targeting stabilized, cash-flowing real estate in the Midwest. Growing markets, solid job growth, solid population growth, mostly B and A class assets. We think it's kind of actually in the sweet spot right now. Right. Mostly suburban properties. We've got first two assets in the fund. One's in Indianapolis. The second one is going to be up near Lansing, Michigan. Again, all great markets, both suburban locations, solid job growth, all the metrics you'd want to see. Go check it out, gray.fund, and then subscribe and do all this fun commenting and stuff. Matt and I will catch you next week on the next episode of the Gray Report. Stay smart, make some good investment decisions, and have a good weekend.